Did you know that South Africans spent 354 billion on food and alcohol?
Amount of money is being spent on alcohol. Imagine the dynamic if we were to shift focus and put that money maybe in investments.
So would you advise or not advise the person to take a credit card?
It depends, I say on you as an individual. Yeah, but now let's unpack the concept of risk cover.
If nothing happens to me, then what happens to my money?
But what happens when something happens to you?
No, but.
No, we can't always
No.
There's no risk there.
So you're meaning to tell me if nothing happens to me, that money is gone?
But when something happens to you,
bad for me.
But when something happens to you,
Did you know that South Africans spent 354 billion on food and alcohol over the past 12 months? Ladies and gentlemen, my name is Masi, Biyela, and welcome to another episode of Uncaged. Today, we are talking everything money and economy. Guys, please help me welcome Thanda Madiba. Hello.
Hey, Masi. Thank you so much for that lovely welcome.
I need to put it out there. We are talking money. So guys, Thanda is a financial advisor. So he'll just be taking us in basically what happens when you are a financial advisor and what's in that world. So yes.
Yeah, perfect. I love the introduction. That's a scary figure.
It is.
Really, we should not be proud of that. Amount of money is being spent on alcohol. Imagine the dynamic if we were to shift focus and put that money maybe in investments. We'll be a generation that really would change the world. Will basically take the whole direction of our financial prosperity to another dimension.
You know, when I read that, when I saw them, the figures, my idea was that means a whole lot of South Africans are in debt. Because there's no way that we have that much of money and we are spending it. So it's the most.
Wow.
You know, and I was reading my statistics. It's the most that South Africans have spent.
Kushukuthi, you're saying, Jabasi, we're having the social assistance by the state, government giving grants and stuff. We're counting that and we're saying we still borrow on top of that because we're not the wealthiest of people, right? So most of us would be obviously funding the consumption of our alcohol, our entertainment, the clubs from money we don't have.
Money we don't have? That sounds so scary.
From credit cards, maybe?
Oh my God. Yeah, one of the moments you say credit cards, G. It's nice when the money is there. You think you have it because when you look at your app, it's like the money is reflecting. The problem is when you have to pay it back. I don't like the whole thing when it comes to interest. Can you just break that down for me? Interest rates.
Yeah. I think we basically on it now that we spoke about the credit card. The fact that it's money we don't have. And then the bank wants to make a profit by giving you that money, the money that you see that's always tempting to spend. It's basically a way the bank wants to, get business. So they charge you a fee for having that money, especially when you spend it and don't pay it back in time. Because there are people who can utilize their credit card quite effectively. Maybe they shop with it and they get points and they cycle that money quite effectively. It builds them a good credit score and so forth. They don't use it mostly to consume. They buy purchases that they can pay off, slowly, but they maintain regular payments. So it's good. But then when we use it as a way to basically sustain our income or what's your word, complement our income, then it becomes a problem because that means there's a deficit. We should really be looking at lowering our standards of expectations and live within our means.
I think what I caught in all of that is live within our means.
Because the interest rate, it's going to be there when you are paying that extra money. Mashonis, banks are, they're there for the business as well, and financial institutions. So you get an overdraft, you get a credit card, money available to you. It must be paid back with interest. So the idea is to try and make sure that your payments are done in time or even before, even extra, and reduce the debt burden as much as you can.
So would you advise or not advise the person to take a credit card?
It depends, I say on you as an individual. We can't have a blanket approach. Some people are disciplined. There are those people that know how to use money well. That might be not a bad option for a person like that. Upbuild the credit score. He's getting exposed to a certain level of debt. Eventually, some form of debt will capture us, whether we are on a home loan, car finance and stuff.
Yeah.
There are certain things we can't pay off upfront or cash.
Of course.
So, then those facilities can come handy.
Okay.
But umanje yabona just for splashing and buying clothes, and then I'm finding myself saying go debt reviews and Google credit bureau. It will be very irresponsible, so if you don't need it, there's other ways of building good credit exposure or records. Like for example, take an investment or risk policy. Your risk policy also reflects as a regular payment. It shows that you are responsible because if there's anything that should happen to you as an individual, you can, have some sort of cover. And when I talk about things happening, I'm talking about, as we sit right now, the roof can fall on us. Things can happen. But those things do not have to be a hindrance to our financial destiny, our journey. We can have some sort of ways to mitigate.
So just to go back, because you mentioned risk cover. Say I take a risk cover. Am I waiting, because it's going to be deducting imali every month. Do I wait until something actually happens to me before I have access to the money, or can I access it? Is there a period of time?
Yeah, but now let's unpack the concept of risk cover. Who's taking the risk? Both parties.
Okay.
I will, in this instance, represent the insurance industry. You must say. All right? So you're taking the risk. I'm giving Thanda, let's say 500 Rand a month. Thanda is going to be making sure that if I go to the doctor and the doctor says, "Ooh, I'm sorry, you have to come for a second check. That doesn't look too good. I'm worried." And then when you come again, he says, "You know what? Sit down." When the doctor says sit down, it's about to get down. And he says, "I have found this to be cancerous." That's where the risk now has come to fulfillment. My risk now means that I have to now pay
for the treatments.
As agreed. I might have said, give me 500 Rand. In the case that you are diagnosed with a dread disease, I will give you 1 million Rand to assist you with that situation. So you give me the results from the doctors. You said insurance industry. This is what I have been diagnosed with. And if it meets, obviously, the criteria that your financial advisor would have taken you through. Because that's very important that a financial advisor takes you through what you're covered for properly. Then it's a matter of now your bank account being verified, money being put to your bank account. You can deal with that risk. But what risk are you taking? You're paying those 500 Rands. It can be year 1, year 2, year 3, year 4, year 20. You just remain healthy. Nothing happens.
That's where I was getting at. Like, if nothing happens to me, then what happens to my money?
But what happens when something happens to you?
No, but.
No, we can't always
No.
There's no risk there.
So you're meaning to tell me if nothing happens to me, that money is gone.
But when something happens to you,
bad for me.
But when something happens to you, where that money must come from?
Hypothetically speaking, I don't get diagnosed.
Yes.
Nothing. I'm just healthy. Just little things, the flu now and again. But
you see, we can have this discussion for a long time. Hypothetically speaking, the very next day after me and you signing that contract, you become diagnosed with a critical illness. What happens then? So you would receive money without paying a cent. Because that's the risk some insurance companies are willing to take. That's a commitment they have to their clients' well-being, you see. So we have to consider risk for what risk is. It's like taking a spare wheel and putting it in your car. You can drive for years, nothing happens. But the day that tire bursts, you're not going to regret that, I bought this tire. You know what? For years I bought this extra tire. I could have taken that money. You need that extra tire. You need your car insurance. You need to insure yourself as well.
I feel like we're sitting on what ifs, yeah.
What ifs? That's actually the whole basis of insurance.
Yeah.
Actually, you touched a very potent point. What if? Insurance is an answer to what if? What if I die? What happens to my daughter? Who takes care of her? What if I become disabled? How do I keep on earning an income? Because my job needs me to be occupationally active. So when I'm incapacitated, how do I still maintain my level of life? What if I don't die? I live till 100. Do I have enough provisions to take me way after my earning potential has been passed? So in essence, when we talk about what ifs, we are talking about very important things to consider. But you see the challenge we are having, because we don't want to deal with that. We go to the tavern. There's no what if there. But it's not a responsible way to manage, things that can happen.
So, from your opinion, being a South African and being a financial advisor, are you, how do I put it? Do you think as South Africans are very, spend our money very loosely, if that...
Masi, there's weird thing. South Africans, in general, are very responsible people. Let's think about Abazalbet. You'll find umama that is she's raising 5 kids, single parent, takes them to university. Udlali stokfela ngapha is stokfela sokudla. There's children with December, they are living amazing life. Umama udayisa inyama ngaphakathi usebenza kitchen. There is something there that needs to be credited. I just feel that somehow, maybe our generation takes it a little bit too easy. A bit too for easy. Granted.
Okay.
The fact that legacy of hard work and responsibility, is starting to become less now. Maybe it's because of not having enough awareness.
Probably. I think what we do lack is information. We don't do our research. And coming back to the research part, we would see, do you think that majority of South Africans, young people, need to have a financial advisor?
100%. Look, funny enough, if you were to do a survey, find out how many people have personal trainers. And let's compare that to people who have financial advisors.
Yeah.
I don't know. I would think a lot of us want to look good. We'll try and invest on that because, we see it like immediate benefit, right? The problem with not having a financial advisor is that it's when there's a crisis that you realize you actually need one. And that's not always the best time to start.
I think it's the perception around having a financial advisor. It's the fact that if I'm earning 4,000, 5,000, why do I need a financial advisor? I don't have enough money to even, I don't even know how much you need to pay a financial advisor. So the perception is that people in business, people who have money, lots of money, are the ones who need financial advisors. So for me, if I'm earning 4 or 5K, is not coming up little money for a financial advisor.
No, you're right. I think we do get those perceptions a lot. However, did you know that having a financial advisor actually is the one thing that won't cost you a cent? If you should get hold of me, somehow through this channel, I won't charge you for having a conversation.
He won't charge you.
There's no charge for that. There's no basis charge for us having a financial conversation. We'll just have to give our time to sit down and let's discuss now your portfolio, where you at, or you're earning 4,000, you're earning 5,000. What are your goals? What are your objectives? What are your current circumstances? Do you have dependents? And then from there, we know, okay, this is where we're going to start. We start from the bottom. It's like building a house. You must look at the foundation we are going to build on. And it can be a simple thing, like saying, help me with the budgeting exercise, Mr. Financial Advisor. You see, that doesn't have to cost you anything. We're just basically looking at your spending habits, like your personal trainer would do, right? Sometimes you would look at how we're eating. Exactly.
Okay,
and you see, I think you're right when you said there's a misconception. Yes, unfortunately, our industry has had to be regulated a lot of recent years because, quite frankly, some of in the industry were not doing what they were supposed to do. So there's been a lot of effort to really, bring up the profession. So we actually in a better time now.
Is it?
Yeah, than before.
Okay. Wow. All right. Well, at least I'm learning something in terms of saving money, because that's really something that is difficult. I know that I have a savings account, and then I think this happens to pretty much a lot of us, whereby you transfer money there. And you're like, okay, I'm saving, I'm starting, and then a few days later, that money is out of that savings. I suppose looking at the personal trainer thing, that also helps if you have a financial advisor, because at least you wouldn't need to do that. If you had a financial advisor, you just transfer, leave it there.
Look, there would be some sort of taking in responsibility, right? Some sort of responsibility to your journey. What the financial advisor does, it just is like your co-pilot. So you still drive. He just tells you, this is what you must look out for. This is what you must start planning for now. For example, if I'm 54 and I'm to retire at 55, would that be the best time to start my retirement plan?
No.
When would be the best time?
I actually wanted to ask you.
When you're earning 4,000. Because, think about it this way. If I take, hypothetically speaking, 100 Rand of my 4,000, and I said, this will go towards me when I'm 60 or 55 when I retire. But I'm consistent. As my earnings become higher, I put more. You see, the habit and the understanding and the foundation already puts me in a success. But if I don't have those kind of talks and guidance, I will use that 100 Rand and I'll buy a 6-pack namajit.
Do you think though the whole thing of I don't know, it's gonna sound bad because I'm a female. I just don't like cutting down. I don't like cutting down because it's just the reality of I feel like it kind of tells you, oh my God, I'm going through a financial crisis. That's the thing. And I wanted to get to a point where I don't know which field in terms of financial advisory part. Yeah, because I also wanted to, there's an episode that we did in terms of businesses as well. So I don't know if you have insights in terms of
contingency planning.
Yeah. So I want to know the different types of fields that are there when it comes to policies and all of that. But something that is relatable for a person like me.
Yeah.
You know, because I'm not looking at, retirement. I had a different perception of it, but it actually makes sense when you put down. I'm still on the risk one. I'm still,
risk is relative, yeah. But okay, so I'll answer your first question.
Yeah.
Of course, if we look at it in this way I've been trying to put it out, building a house, you've got your foundation. So there you have your life cover, your dread disease, maybe we put in disability, your medical expenses. That's part of insurance.
Sorry to catch you in there. So I'm trying to get, you said, I see life cover.
Yeah, we can put it all together.
So life cover comes with dread disease. So life cover is different from risk cover.
So your life cover is under risk umbrella.
Okay.
The risk of maybe dying too soon.
Yeah.
And then my children have nothing. Gets covered by my life capital payment that I would be getting from my life cover.
Oh, okay.
But then there's also a risk to me. Maybe I pick up a critical illness, dread disease, stroke, whatever, or disability through accidents or whatever. Then obviously you've got your medical aid. It's also part of medical insurance scheme. And then you have also in there maybe gap cover, which funny enough is a build on medical aid, where medical aid cannot pay because medical aids also have a threshold.
Okay.
Then you have to utilize gap cover. So that's if you have, it's very rare when you're young, but it happens to life in general. It's about covering our risk, right?
Yeah.
If, for example, I pick up a really, really critical situation which requires me now to get major surgery and I find that my medical aid does not cover that. And we also have medical insurance, which also is part of your contingency plan for in case you get sick. You can also use that. It's a little bit cheaper. So you see, in every stage and based on your earning potential, you can put some sort of plan.
Yeah.
The key word is plan. And then you've got, your short-term insurance, can be your car insurance.
Yeah.
So those are all type of
different
plans, Your home loan needs to have an insurance of some sort.
Yeah.
You can either use your life cover for that. If it has the components like retrenchment cover, that needs to be part of, if it's going to be for your home loan. And then we have investments. That's our goals.
I think I like the investment.
Yeah, that's one appeals a lot when we're young because we're thinking of the future. Yeah, but imagine investing for 5 years and on year 2, you're investing maybe to get 100,000. And then year 2, you meet up with a tragic accident. Where would you get the money? Where would you get the money to carry on with your investment?
So that's where you come in.
So that's where that spare wheel plays a role. See, you can't drive to Joburg just saying, I've got 4 wheels, I'm fine. But what happens if you have a puncture? Will you get to Joburg?
Of course not.
See, you have to have your risk in place. If
you've like been financially, he's just there.
But it might be different risk for you to me. For example, if I have dependents, I might require more cover than somebody who doesn't.
Yeah.
So it's not a matter of just taking in this thing because it's there. Someone says you must get it. It's about you as the individual.
Yeah.
So it's about really doing a holistic financial analysis. That's where I'll start with you if you are my client.
Yeah.
By the way, who's your financial advisor?
On to the next question. On to the next question. Oh my God.
It's getting hot here.
It is. It is. I don't know if we should take a break or what. Well, another thing that I want to know is, how do you recommend diversifying a portfolio in today's market?
That's a good question. Yeah, investments are, funny enough, I've spoken a lot about risk, right?
Yeah.
But investments are actually my passion. I love investments. And when I build my client's portfolio, I look at, let's say, maybe we have some money offshore. By that means we know now America has a new president. There's certain expectations on the economy front. And why not take some of your rands there? Let them grow. All right? And then that says if there's anything that should be happening locally, at least some of your rands are kept there. They are not affected by what's happened. That's, I guess, what you are asking about diversifying.
Yeah.
And then it's different now. We just looked at geography. We just said we made an example of 2 locations, right?
Yeah.
Then there's also this, what we call asset diversification. So you might be saving or investing in companies, but what about also investing in other forms of like, for example, bonds? Bonds are when people take out, when the governments sponsor or need to do projects, they actually now issue bonds whereby people can put some money there. When those projects yield their desired outcomes, they become profitable, obviously based on the time that the government would pay a certain portion back. And that's how they fund what they have to do. In return, you get to benefit from the interest or the returns that will come from putting your money in those projects. So you're not building, but your money is building.
That's actually interesting. Yeah. That is actually interesting. I think investment is something that I want to look into.
Investments are something we should all... I would love, when young people are having fun and somewhere, and they'll have an investment discussion. What are you invested in? Where is your money, growing? Let's have those discussions and make them trend.
Okay.
Who's your financial advisor?
I mean, okay. Well, there's so much that I would like to know, and I'm sure we're still going to have these financial talks, because I definitely want to have an episode whereby we are talking investment. I think that is something that we do need to look into as young people. Think about the future. We were having a conversation with some of my colleagues the other day, and it was the whole thing of a lot of our parents back then, it was more of meeting ends meet at the time. Correct. So you're not thinking about the future. So we want to look at situations where we talk about generational wealth. Yeah. So I need to know that the kids I'm going to have and the kids that, or my kids are going to have their kids, and they're sorted. Yeah. But, before we go, I want your take on this, because I think this whole trust fund thing, if you can just break it down for me.
Yeah, you should be a financial advisor.
Do you want me to be your financial advisor?
You see, what you just linked there, you spoke about legacy. Yeah. And then you said to me now, trust fund. That shows that you understand the correlation. So trust funds are basically a way to also make sure that your interests are carried out. For example, there are people who benefit from trust funds that were created years ago. Maybe their great-grandfathers bought property or farm, and they said, we want this farm to stay in the family. So people with this name and who are come from this lineage must be beneficiaries from the proceeds from this farm. So we do the same, but you can do it obviously through different ways. Yeah. Sometimes even having a will, you can create a testamentary trust. Yeah. Where by if anything happens to you, your proceeds, your estate is distributed to those people that are in your will. And if they are young, they can't take care of themselves. The trust now works as the way to make sure that their interests are covered, because the trust would have certain laws that allow no one to really interfere with that plan.
That is so interesting.
So it's a way of basically ensuring that certain things are carried out. Whether it's money or a property, it's carried out to serve the interests of those that are protected by the trust.
Okay. Well, we're definitely going to be having another episode, because he touched on the will part. So that I want us to break down who can actually write a will and what is the right age to do it and all of that. But we will talk about that in due time. For now, thank you so much.
Thank you.
Thank you.
Hot discussion.
I'm going to place you on the hot seat next time,
But listen, I'd love to interact with the viewers. So I'm open. We can set up our times to allow us to have those discussions. You can get a hold of me on LinkedIn, Thanda Madiba, and also through your channel.
Of course. Well, there you heard it. I just feel like he's been selling. I feel like, you know what I'm going to say? I feel like you kind of sold me on the financial advisor part. We're going to get to that conversation after.
Yes.
But anyway, guys, thank you so much for tuning in. Thank you, Thanda. And you know where to find us on Instagram. It is Uncaged. That is UNCVGE. And TikTok, Facebook. Same thing. And what's this? Me, Masi Biyela. So it's Masi _Biyela on Instagram, Masi Biyela on Facebook, Masi Biyela on TikTok, and also to my crew, as always, thank you. I have F Money, I have my Eddie right there, and I have Geniclens. So I got that. I got it, guys. We will catch you next time, and thank you.